Good afternoon, ladies and gentlemen. This is Mev Money, and today we are here to discuss the case of Citroen Capital shorting GameStop. But first, please give a massive round of applause to our guests, Jeremy Grantham, Michael Steinhardt, Katie Wood, and Warren Buffett. Before asking some questions, let me just introduce the case to our audience. GameStop is a gaming and trading retailer. Since 2017, the company's revenues have been decreasing, which can be associated with a customer preference in the digital world instead of physical game discs. On the other hand, Andrew Left is a short seller and the founder of Citron Research. On 21st January 2021, Left posted a video explaining in 5 reasons why he believed GameStop's shares were overvalued and therefore predicting share price would drop. However, retail investors bet differently, and by buying stocks, they actually made the price increase. On 26 January, as you can see, stock prices reached the unbelievable value of $148. As Elon Musk says, what a game stunk.
Good afternoon, Jim. You mentioned Andrew is a short seller, but what's short selling?
Great question. Short selling consists in borrowing a stock and immediately sell it. If someone short sells, it's because they expect the price to decline. So after they sell it, they will buy stocks on the market with the expectations that prices are lower and profiting that difference, and then return the stocks to the original owner. While short selling can play an important role for efficient capital markets and has several advantages, naked short selling, is more problematic and also illegal in many financial markets. Even with its advantages, short selling can be very risky. But by having call options as well, the investment becomes less risky because even if the price increases a lot, the investor can always buy the stocks to return to the original owner at the agreed price that the call option establishes. Also, it is very important to know when to invest. Otherwise, the investor might find it difficult to hold on to the short position or even have huge opportunity costs. Investing during a bear market or during the deterioration of stock fundamentals are a way of improving the odds of success. I know I extended myself a little, but I really want the audience to be informed about this topic. Did I answer your question?
Yes, you totally did. Thank you.
Welcome, and feel free to ask any other questions. Speaking of questions, Grantham, can a big short seller as yourself explain to the audience the difference between going long and selling shorts?
Good afternoon, everyone, and thanks, Jim, for having me. Financially speaking, going long is about buying a call option, meaning that the investor owns the security and maintain long security positions with the expectation that the stock will rise in value in the future, so that he or she can profit from its initial purchase. On the negative side, the potential loss of a long position equals its acquisition price, being the associated upside unlimited. By that, we can conclude that the main risk is about to fall in the asset's value. Investors can establish long positions in stocks, mutual funds, currencies, or derivatives. So, a long position is often used to buy an option contract, and consequently, a trader can either hold a long call or a long put option. So, the expected appreciation of the asset's value in the long run and the buy and hold strategy saves the investor the need for constant market timing. On the other hand, the main risks associated with going long relate to sudden suffers on in price changes, short-term moves, and the possibility of expiration before the advantage is complete by the investor. Moreover, because short selling, as Jim told us, is mainly a pessimistic move, the investor faces a potentially limitless loss because there is a maximum price that an asset can achieve. He may face also sudden changes in fees, dividend payments, and margin calls with interest charges. After then explaining both terms, we can conclude that going short is actually the opposite of going long, and the first one is riskier. Once theoretically there isn't a limit associated with the loss of the investor in the short selling case.
Perfect, Jeremy. Thank you. Now, Seinhardt, as Andrew left, I know you are as well a hedge fund manager. I want to know your opinion about his thesis. Do you agree with Left's analysis?
Thank you, Jim. So, Left's first argument is that there won't be a short squeeze and that personally he believes that this appreciation is not explained by fundamental reasons. This was a mistake by Left because he's not taking into account all other investors' willingness to risk, and he also chose to ignore the short interest. The fact is that in the next day, the short interest exceeded 100% of GameStop free float, which means that shorted shares were being relented and shorted again. His second argument is that people should ignore Twitter and Reddit and focus only on numbers. He talks about December of 2020, that was the best month ever for hardware sales, and that even at that time, GameStop could not make a profit, blaming it on the business model of GameStop of buying and selling used games, and that they were being traded for other retailers such as Amazon and Walmart for that reason. This is really not the case why this is happening, because we have other companies, other lucrative companies such as CEX. They operate in the same business model as GameStop, and the main difference between those are the prices they give their clients for their used games. So I believe the problem is really not the strategy, but how it is being implemented. In his third argument, he mainly refers to EV by EBITDA ratio, which was trading at 40 times at the time, and compares it to other companies such as Apple, which was trading at 23 times, Walmart 13, and Best Buy 7, proving that by this ratio, the company could be considered expensive and overvalued. In his fourth argument, he especially talks about Melvin Capital and how big of a fund they are, trying to imply that if such experts have the same opinion as him, he must be right. The problem here is that even though Left is right about the fact that the stock is overvalued and it is really not appreciating by fundamental reasons, he's not following his own advice. He did not take into account the retail investors' ability to join together and act towards a common goal, so he's failing to identify the capacities of the group that was against him. His final argument is that the company can take the opportunity to sell part of their stocks to buy another company, referring that in this industry, acquisitions are usually really expensive. It is true, especially for developing and publishing companies such as Activision, that was recently bought by Microsoft for 68 billion. But in this argument, he contradicts himself when before he said that GameStop main competitors were other retailers such as Amazon and Walmart. So it really does not make sense for them to try to buy one of these huge retail companies or to try to buy one developer company to try to start some new strategy of developing their own games.
Couldn't agree more, Steinhardt. Now, Katie Wood, the audience really wants to hear what an investment manager has to say about the pattern in GameStop's price over 2020 and 2021. What could justify that, in your opinion?
Well, Jim, to explain this briefly, during 2020, the market feeling was bearish in relation to the future of GameStop. So, institutional investors, like Andrew Left, start short selling the company stocks in the hope of a decrease in price. However, this was not the case because at that time there were more retail investors due to the democratization of finance, the access to platforms like Robinhood, in which you don't have to pay commissions to trade American stocks. And as people were at home because of the COVID situation, they spent even more time online. This led to a rise in retail investors, some of whom were members of the Wall Street Bets Forum, who started a discussion that became a movement against Wall Street large hedge funds. These retail investors start to buy GameStop stocks, leading to an increase in price, causing losses to some of the Wall Street hedge funds, which had sold short the stocks and needed to close their positions to stop their losses. This situation increased demand even more and led to a sharp increase of prices. This last phenomenon is called short squeeze. Well, in conclusion, one of the main risks of high values of short interest, which is basically the number of shares current sold short divided by the number of shares outstanding is the phenomenon of short squeeze, especially when we are facing unpredictable situations like this. Curiously, the scenario that gave the name to the Robinhood app really happened. Some retail investors became wealthy and large hedge funds lost a lot of money.
Thank you, Katie. It's always enlightening to hear from you. Now, final question. It is 19th of September 2022, and the GameStop shares are trading around $28.96. Warren Buffett, the world wants to hear what such a successful investor as yourself has to say in this matter. Would you short GameStop?
So thank you, Jim, for such a pertinent question. Considering the stock evolution through the last years before the short squeeze that the other guests talked about and the worst results the company has been having year after year, we could think that the stock value will continue to fall. So in that case, it could be a good decision to short sell GameStop. However, we can't forget what happened between December 2020 and January 2021, when the price of the stock rose abruptly, not because of the GameStop results, but only because a lot of non-professional investors started to buy shares in a very big volume, creating big losses in investors who had short selling positions in the stock. We don't know, now having GameStop stock the label of meme stock, if a situation like that can happen again soon. So it can be very risky to short sell it, even the last results does not show a growth for the company. Moreover, the results for the last quarter, although worse than last year, were better than expected by investors, which can show signals that the new administration is trying to recover GameStop value. We should also pay attention to the retailers' perspectives for the future. The focus on the digital world with cryptocurrency partnerships and NFTs, the hire of lots of people experienced in areas such as blockchain and the investments to modernize the business, shows that GameStop wants to keep with the future evolution of businesses, what can be a signal of increasing value for investors in the future. In addition, I know that lots of investors with short selling positions are losing money and closing their positions, which shows some concerns with the evolution of the stock and the possibility of new investors losing too. Finally, borrow fees for GameStop stocks are very high, which indicates a higher chance of short squeeze. Concluding, with all the reasons I said above, I think that short selling GameStop stock is too risky and can lead to big losses by who decides to do that type of investment. So today, I wouldn't short GameStop.
What a complete answer. Thank you so much, Warren, and thank you, Jeremy, Michael, and Katie. This was a lovely session and definitely a lesson about financial literacy, which is so important. Thank you all for watching us, and good evening, everyone. We will be back for more episodes next week.